Let's face the cold hard truth, you are being used as exit liquidity for the Wall Street elite. While you were busy buying into the glossy AI dreams spun by the media, the financial giants were already packing their bags and slipping out the back door. The AI bubble isn't a future warning anymore, it is popping right before your eyes. Ever wondered why market darlings like Nvidia and Apple are suddenly getting dumped without mercy? Today, we are exposing the bitter reality that nobody else wants you to see. Just look at the cold numbers. Smart money doesn't act on emotions, they act on brutal mathematics. Nvidia's astronomical rise over the past year was like a rocket engine running out of fuel. When major hedge funds start locking in billions in profits, they are sending a clear signal: the game has changed. You are holding the stock out of hope, while they are dumping because they know exactly where the limit of this madness lies. And what about Apple? They tried to jump onto the AI roller coaster by painting a flashy vision of Apple intelligence. But Wall Street is no longer fooled by those old marketing tricks. Consumers don't want to shell out thousands of dollars just to upgrade a phone that can draft a few text messages. As sales stagnate and enthusiasm cools, institutional investors are realizing the Cupertino giant is losing its breath in this race. What is the truth behind the closed doors of hedge funds? It's large-scale short selling and stock distribution. They don't dump everything in one day to avoid panicking you. Instead, they distribute gradually, bit by bit, turning retail investors like you into the ultimate bag holders. You think you are buying the dip, but you are actually catching falling knives from the peak. To understand why this is happening, you need to understand the anatomy of a financial bubble. History doesn't repeat itself, but it often rhymes. From the tulip mania to the 2000 dot-com bubble, every madness begins with a genuine breakthrough technology, but ends with wild speculation built on fantasy. AI is undoubtedly the future, but its current valuation is pure fiction. What is the biggest pain point in the tech industry right now? It's the ROI problem, return on investment. Companies are dumping hundreds of billions into buying Nvidia's GPUs to build massive data centers. But what is the actual revenue generated from these AI services? Barely anything. Once enterprises realize they are spending far more than they are making back from AI, they will shut off the tap. Look at the capital expenditure, CapEx, frenzy of the tech giants. Microsoft, Google, Meta, they are all in a frantic arms race. They are so terrified of falling behind that they are throwing cash out of the window just to hoard Nvidia chips. But Wall Street is losing patience. Analysts are asking, when will this massive pile of cash yield real profits? The silence from the CEOs is the spark for this massive dump. Here is the dirty secret of the AI economy, the closed spending loop. Microsoft invests in OpenAI, OpenAI uses that money to buy cloud services from Microsoft, and Microsoft uses that money to buy Nvidia chips to power OpenAI. It is a perfect financial circle of illusion, creating the appearance of massive revenue growth. But when external organic revenue fails to enter, this loop collapses like a sophisticated Ponzi scheme. The fear of missing out, FOMO, in Silicon Valley has driven everything way too far. Startups only needed to add .ai to their names to raise millions without any viable business model. It is identical to the late 90s dot-com fever. Venture capitalists have been heavily drunk on this party punch, but now, the hangover is setting in, and brutal reality is knocking on their doors. Think about this, the hardware market always has its limits. Once all major data centers are fully packed with Nvidia H100 chips, what happens next? Demand plummets. Nvidia cannot sustain a 300% revenue growth rate forever once the market is saturated. Wall Street knows this, and they are dumping the stock before the upcoming quarterly reports expose the inevitable drop in sales. Nvidia's gross margin is currently at an unbelievable level, nearly 75%. This is a software monopoly level margin, not for a manufacturer of physical hardware. This hyper-profitability acts as bait for sharks. Competitors are drooling over this pie, pouring billions to break Nvidia's monopoly. The days of these supermargins are numbered. Remember, Nvidia isn't the only player who knows how to build chips. AMD is aggressively catching up with their MI300 series. More dangerously, Nvidia's biggest customers, like Google, Amazon, and Meta, are designing their own custom chips, ASICs, to cut dependency. When your biggest clients become your biggest rivals, your crown begins to slip. Wall Street has an ironclad rule: buy the fear, sell the euphoria. When you see financial talking heads on TV constantly telling you to buy and hold Nvidia for the long run, that is exactly when they are dumping their shares onto you. They need your optimistic retail money to cash out their massive holdings at the absolute top. Are you aware of dark pools, the private exchanges used by institutional giants? This is where massive blocks of shares are traded completely out of the public eye to avoid shifting the stock price instantly. By the time these private distributions are complete and hit the public exchanges, the price drops. When you see it on your screen, it's already too late. This is how the psychological trap works. A rising market breeds overconfidence. You watch your portfolio grow daily and convince yourself you are an investing genius. But that is just the cheese on the mousetrap. When the trap snaps shut, all your paper gains evaporate in a few trading sessions, leaving you with nothing but heavy losses and regret. Now, let's pivot our lens to Apple. What is their ultimate nightmare? It's the saturation of the global smartphone market. The iPhone is no longer a technological revolution, it has devolved into tedious, incremental annual upgrades. As the consumer replacement cycle stretches from 2 years to 4 years, Apple's money printing engine is starting to rust. What actually is Apple Intelligence? It is not a revolutionary, ground-up AI model built in-house. Stripped of marketing, it is mostly a wrapper interfacing with OpenAI. Apple is forced to pay others to rent their AI brains. This proves they have fallen catastrophically behind in core AI research and are now playing a desperate game of catch-up. Western consumers are financially exhausted by inflation. They are dealing with surging energy bills and high living costs. Do you honestly think they will eagerly shell out another $1,200 just for an iPhone that runs basic AI tasks they can do for free on a laptop? Consumer fatigue is a structural wall that Apple cannot marketing hype its way over. And let's not overlook the massive regulatory walls. In Europe, strict Digital Markets Act (DMA) regulations have blocked Apple from deploying its new AI features. In China, intense national competition from Huawei combined with government bans on foreign devices is squeezing Apple's throat. They are losing their most lucrative growth markets. But the biggest shockwave that woke Wall Street up was Warren Buffett's silent move. His conglomerate, Berkshire Hathaway, quietly dumped nearly half of its massive stake in Apple. This isn't just a routine rebalancing, it is a historic warning shot. The world's legendary value investor is liquidating. When the Oracle of Omaha cashes out, you should ask yourself why you are still in. Berkshire Hathaway's cash pile has hit a staggering historical record, nearly $277 billion. Let that sink in. The most disciplined investor on earth would rather hold cold hard cash earning modest yields than reinvest in this stock market at current insane multiples. He is hoarding dry powder for a massive crash, while you are picking up pennies in front of a steamroller. If Buffett is out, why are you still in? Do you honestly believe you have better analytics than Berkshire's team? Or do you trust free advice from TikTok gurus more than the actions of a legend who survived dozens of market crashes? It is time to drop your ego and look straight into the brutal mechanics of how money actually flows. The ultimate illusion of retail investors is believing the stock market only goes up. We have lived through a record-breaking bull run fueled by cheap credit pumped out by central banks. But the tide of liquidity is now receding. When the tide goes out, you find out who has been swimming naked. Nvidia and Apple are just the first giants to feel the chill. We are living through the longest era of restrictive high interest rates in decades. The Federal Reserve has held rates above 5% to combat persistent inflation. Money is no longer free. When the cost of capital skyrockets, the high multiples of tech growth stocks, which rely on earnings far in the future, get brutally discounted. That is basic finance. The Fed is walking a knife edge. On one side is the abyss of reigniting inflation if they cut rates too fast. On the other side is systemic financial collapse if they hold rates high too long. This deep uncertainty is Wall Street's worst nightmare. In this high-risk environment, smart money shifts to safe government bonds rather than betting on bubble tech. Ask yourself, how much has AI actually boosted your daily workplace productivity? Or is it just a slightly smarter tool to rewrite emails? The massive chasm between the hype of superintelligence and the reality of basic utility tools is becoming glaringly obvious. When the real-world utility fails to justify the valuation, the bubble pops. Let's wind back the clock to the year 2000 for a brutal lesson. Back then, the internet was hailed as humanity's greatest invention. Telecom companies spent hundreds of billions laying fiber optic cables worldwide. They assumed demand would be infinite. But the hardware far outran practical applications. The result? A multi-year tech winter and bankruptcies. Cisco Systems was the most valuable company on earth in 2000, selling the hardware for the internet boom. They were the Nvidia of their era. Everyone thought Cisco was untouchable. But when infrastructure construction finished, their order book suddenly went cold. Cisco stock lost nearly 90% of its value and has never retaken its peak a quarter century later. Will Nvidia repeat history? The infrastructure build-out phase always has a hard stop. You cannot build massive, expensive data centers indefinitely when actual utilization rates remain incredibly low. Once tech giants realize their current compute capacity far exceeds real demand, they will freeze new projects instantly. That is Judgment Day for hardware vendors. The real bottleneck is no longer hardware, it is software monetization. It's incredibly easy to buy 10,000 GPUs and plug them in, but extremely difficult to build an AI application that millions of users happily pay for month after month. Until this software monetization puzzle is solved, the entire AI trade remains speculative hype. Observe the bizarre behavior of tech giants today. They are laying off thousands of skilled engineers and cutting employee benefits, while simultaneously spending billions on AI chips. This is a desperate distraction technique. They need to show Wall Street they are future-proofing to prevent stock crashes. But this cost-cutting game can't mask internal decay forever. There is a brutal physical bottleneck that tech evangelists ignore in their sleek PowerPoint slides: power grid capacity. AI data centers consume astronomical amounts of electricity, comparable to entire small nations. The aging power grids of the West are not built to handle this insane load. This physical reality will stall AI scaling faster than any competitor. Have you noticed big tech companies signing direct power deals with nuclear power plants? This sounds highly futuristic, but in reality, it highlights their desperation. They are so desperate for stable energy that they are turning to legacy nuclear power. This is an extremely capital-intensive, multi-year play. Time is not on the side of a hyperinflated bubble. The massive operational cost of running large language models is a quiet crisis. Every single query you type into ChatGPT costs dozens of times more energy than a traditional Google search. As user bases grow without sustainable monetization, these AI companies lose more money the faster they scale. This is a self-sabotaging business model without VC subsidies. Wall Street is initiating a quiet but aggressive sector rotation. They are taking capital off the table from overvalued tech growth stocks and rotating it into defensive sectors, traditional energy, and consumer staples. This is a textbook signal of a late-stage market cycle. The smart money is playing defense, while you are still chasing paper dreams. Multiple compression is finally arriving. When a stock is priced to absolute perfection, even slightly less than stellar news can slash its valuation by 30% to 40% overnight. Wall Street is repricing Nvidia not as an infinite growth tech savior, but as a highly cyclical hardware manufacturer. This paradigm shift is brutal and unforgiving. Here is your major aha moment: the entire global AI infrastructure is heavily overbuilt. It is the digital equivalent of constructing a 12-lane superhighway through a remote village where only a dozen people walk. The technology is amazing, but the investment scale has run decades ahead of real-world demand. The market correction to realign this will be painful. Let's strip away the hollow marketing buzzwords. When a company claims they are using AI to revolutionize their product, they are often just rent-leasing simple API endpoints from OpenAI. No moat, no proprietary IP, no real competitive advantage. Wall Street has seen through this facade and is now ruthlessly cutting these hype riders loose. Behavioral psychology dictates market cycles. Retail investors always cycle through the exact same emotional loop: skepticism, excitement, complacency, denial, and finally, panic selling at the absolute bottom. Right now, you are standing on the fine line between denial and the painful acceptance that the party is officially over. Stop staring at intraday charts for answers, watch the macro capital flows. Stock prices can spike temporarily due to retail FOMO buying, but primary trends are dictated by institutional titans. When they have made the strategic decision to exit, every technical bounce is just a bull trap designed to catch latecomers. Smart money always adheres to an incredibly strict investment checklist. They demand businesses with robust free cash flows, realistic valuations, a strong margin of safety, and irreplaceable products. High-flying AI stocks completely fail to check these boxes today. That is why they are discarding them without hesitation. How do you protect your portfolio from the impending tech wreck 2.0? The very first step is to stop falling in love with your stocks. A stock is not your spouse or your religion, it is purely a financial vehicle. If the underlying macro fundamentals have deteriorated, you must have the courage to act before the market acts for you. Prudent asset allocation is your ultimate financial life jacket. Never put your entire life savings into a single high beta sector, especially one as highly speculative as tech today. Diversify into tangible assets with stable cash flows, physical gold, or simply build a strong, high-yield cash reserve. Many retail investors assume that buying passive index funds like the S&P 500 makes them safe. But here is the catch: the index has never been more heavily concentrated, with massive tech giants making up nearly 30% of its weight. When these tech giants correct, they will drag down the entire index, turning your safe ETF into a fast slide. When massive index funds are forced to rebalance and dump tech to keep their weight limits, it triggers a cascade of automated selling. This is a technical market mechanism that nobody can stop. The exit door is incredibly narrow, but the crowd is massive. The slowest to react will suffer the most brutal losses. The key to surviving this financial storm is not panic selling in a state of terror, but active, calculated preparation. When you possess a solid game plan, you view severe market corrections as premier opportunities to purchase premium assets on the cheap, rather than seeing it as the end of the world. After the storm comes the sun, and after every bubble burst, the true winners of the next era will emerge. These will be the resilient companies that don't peddle hollow promises, but deliver real, practical utility with stellar cash flows. Your primary job is to wait patiently and identify them. Keep a cool head and an unshakable mindset. Never let the chaotic noise of the herd sway you from your disciplined investment principles. The financial market is fundamentally a mechanism for transferring wealth from the impatient to the patient. Absolute calm is your ultimate superpower to win this game. If you want to keep unraveling the cold hard truths behind Wall Street's red velvet curtains and deeply master how the financial matrix operates, hit that subscribe button right now. Together, we will navigate through the market's high tides and protect your hard-earned wealth. Thank you for staying ahead of the game with us. Always take full control of your own financial destiny and never let the herd lead you to the slaughterhouse. See you in the next deep dive. Disclaimer: this content is for educational and informational purposes only, and does not constitute financial advice. Always perform your own research before making decisions.